Hello everyone, welcome to EduTap and welcome to today's session. So today I'm going to take your RBI notifications, RBI press release complete revision session for the July 2024. So I hope you are quite excited for this session because this is going to be very important from your examination point of view. So I hope you are preparing very well for the RBI Grade B 2024 examination, and in today's session we are going to have the revision of the RBI notifications and the RBI press releases from your July 2024. So first of all, give me a thumbs up if I'm clearly audible, if I'm clearly visible. So give me a thumbs up. Good evening everyone. Good evening and welcome to the session. So let's start with the session without any delay, and we are going to revise the important notifications and RBI press releases from the July 2024. Okay. Now, before starting with the session, do subscribe to the YouTube channel so that you continue getting these videos, as well as join our Telegram channel, because in this Telegram channel, you will get the PDF of the session. Okay. So the link for the Telegram channel is provided in the description box below. Okay. So coming to let's start with the MCQs. This is the first question. Try to answer this question. Let's see how many of you are able to answer this question in the correct manner. So this is the first question. Try to answer this question. Okay. Good evening, everyone. Good evening. Try to answer this question. So here, the Reserve Bank of India has released the Prompt Corrective Action Framework, and this question is regarding the PCA framework for the urban cooperative banks. Which of the following statement is or are correct in this regards? That you have to tell me that which of the following statement is correct regarding the PCA framework for urban cooperative banks. So I am getting the answer C, that is 1 and 2. Let's see that if it is correct or not. Okay. So the PCA framework shall be applicable to all urban cooperative banks under Tier 2, Tier 3 and Tier 4 categories except UCBs under all inclusive directions. So PCA framework shall be applicable, it is applicable to all the UCBs, okay, under Tier 2, Tier 3 and Tier 4. Capital, asset quality and profitability will be the key areas for monitoring in the revised PCA framework. So capital, asset quality and profitability, they are the key areas for monitoring in the revised PCA framework. Next is the provisions of PCA framework will be effective from 1st April 2025. The hard-coded limit of rupees 25,000 for restrictions on capital expenditure by the Urban Cooperative Bank under the SAF has been dispensed and has been removed. So there are going to be different limits as per decided by the Reserve Bank of India. So only the first and second statements were correct. The third and fourth are incorrect. Yes, very good. So only C is the answer here, and we have discussed about the PCA framework. We have discussed that before there was the supervisory action framework, and now only the Tier 1 of the primary urban cooperative banks, only the Tier 1 are going to follow the supervisory action framework. The other Tier 2 to Tier 4 UCBs are going to follow the PCA framework. Okay, and they are, if they are not under the all inclusive directions, then the Tier 2 to Tier 4 urban cooperative banks are going to follow the PCA framework. So this is the basic idea. We have discussed about the PCA framework in our previous sessions, and this PCA framework is going to be very important for the urban cooperative banks. This is to identify the weak urban cooperative banks and to make them better, make their health, financial health better. Okay, so this is the idea regarding the PCA framework. Now coming to the next question. Try to answer this question, and this is going to be very important because this is the part that you have to remember, that the PCA framework has what risk threshold. So there are 3 risk thresholds. What are the parameters in this risk threshold, as well as how much the parameters differ. So the parameters are on the basis of capital, that is CRAR, capital to risk weighted asset ratio, the asset quality and the profitability. So these are the 3 indicators, and there are the parameters as per the indicators. So the urban cooperative banks will come under the risk threshold 2 if the capital to risk weighted asset ratio fall up to 250 basis point below the minimum regulatory requirement. So if the urban cooperative banks, for them there is some minimum regulatory requirement of the CRAR. The UCBs have to maintain some minimum regulatory requirement of CRAR. If it is if the CRAR is falling below up to 250 basis point, so that is going to come under risk threshold 2? No, it is going to come under risk threshold 1. Okay, it is going to come under risk threshold 1. Net non-performing advances ratio of greater than or equal to 6% but less than 9% falls under the category of risk threshold 1. So this is correct, that the net non-performing advances ratio of greater than or equal to, if it is greater than or equal to 6% but less than 9%, then they are going to come under, then these UCBs that are having the net non-performing advances greater than or equal to 6% or up to the less than 9%, they are going to come under risk threshold 1. UCBs will come under the risk threshold 1 if UCBs incurred losses during 2 consecutive years. So that is also correct. Okay. So here the first one is wrong, but the second and third ones are correct, and you have to tell me the incorrect statement. So the incorrect is actually 1 only. Very good. Okay. So 1 only is the incorrect statement. So here are the risk thresholds. There are the 3 risk thresholds, and the parameters are capital, asset quality, profitability. Indicators are CRAR, net non-performing advances ratio, and net profitability, and these are the risk thresholds. Okay. So you have to remember that if you are falling up to 250 basis point, that is 2.5, this much you are falling below, this much basis points if you are falling below the indicator prescribed. So then you are going to come under risk threshold 1. If you are falling more than 250 and up to 400 basis point, then you are coming into risk threshold 2, and so on and so forth. And that is for the net non-performing advances. If you are having more than or equal to 6% or less than 9% of net non-performing advances, you are coming into risk threshold 1, and so on. So this is the whole idea of the PCA framework. And the CRAR, what is the minimum CRAR that you have to have? What is the minimum CRAR that you need to have, or that the urban cooperative banks need to have? So by March 31st, 2024, they needed to have 10% of the minimum CRAR. By 2025, they need to have 11% of minimum CRAR. And after that, in 2026, they are mandated to have the minimum CRAR of 12%. So this is the basic idea. Okay. Now coming to the next question, I hope you will be able to answer this question also. So try to answer this. Okay. So here, when a bank is placed under PCA, one or more of the following corrective action may be prescribed. The following corrective action are prescribed for risk threshold 2, except the bank to raise capital either from existing members or by issuance of equity. So yes, this is the corrective action that has to be followed by the like if a UCB is under the risk threshold 2. Okay. Restriction on declaration or payment of dividend and donation, this is also correct, that there will be such restrictions that will be imposed. The appropriate restriction or prohibition on expansion of total size of the deposits. So this is the restriction that only the UCBs have to follow if they are under the risk threshold 3. So the risk threshold 2, if you are in the risk threshold 2, if the urban cooperative bank is in the risk threshold 2, so they do not have to follow this. This is only followed by the urban cooperative banks that are in the risk threshold 3. Okay. So this is the idea. Appropriate restriction on capital expenditure or restriction on branch expansion, all of these restrictions, the other 4 restrictions will be followed by the risk like urban cooperative banks that are under the risk threshold 2. So if the urban cooperative bank is under the risk threshold 2, so they have to follow all the they will have to follow the prescribed mandatory actions of the risk threshold 1 and their own. So all of these they will have to follow, but until the UCB is under the risk threshold 3, when the urban cooperative bank will come under the risk threshold 3, then only they will have to follow the appropriate restriction or prohibition on expansion of the total size of the deposit. So this is the idea. I hope this is clear. So only the risk threshold 3 will have to follow this mandatory action. Okay. Next, coming to the next question, that is authorized dealers were permitted to release foreign exchange for any current account transaction. So read this question and try to answer this question. So here, authorized dealers were permitted to release the foreign exchange for any current or current account transaction on the basis of a simple letter containing basic information. So it was said that if you are doing the transaction of USD 25,000 only, then there is no requirement of Form A2. There is no requirement of providing the complete documents or such. But now the Reserve Bank of India has said that with a view on streamlining the regulatory compliances, now even for the smaller transactions that you want to do, even for the smaller current account transactions, if you want to do, still you have to like fill the form A2 or you have to provide the appropriate documents. Okay, so this is the idea. Yes, it is 25k, that is 25,000 USD. Okay, B is the answer here. So this is the idea, that the release before the authorized dealers were ready and they were providing the foreign exchange for any current account transaction on the basis of simple letters, simple documents, not much documents were asked for the transactions of up to $25,000. But now it has been said that they need to get the form A2. Form A2 is like this. This is the form A2 that has to be filled for any kind of remittances that are to be made. Okay, where all the details have to be filled clearly in a very appropriate manner. So this form has to be filled, or the proper documents have to be provided, then only the transaction will happen. Okay, then only the authorized dealers will be able to do the or complete the transaction or convert the foreign currency. Okay. Now try to answer this question. So as per the revised guidelines for the remittances to International Financial Service Center under the Liberalized Remittance Scheme. So which of the following remittances under the LRS to the IFSCs can be made? So there are the limitations that have been made, or there are certain like guidelines that have been provided, that under the Liberalized Remittance Scheme you can make the transactions, you can under the Liberalized Remittance Scheme you can send the money to the IFSCs, that is International Financial Services Center, IFSCs. So there are, which of the following remittances under the LRS to IFSCs can be made, that you have to tell me, that under the LRS to IFSCs. If you are sending the money under the LRS to IFSCs, which of the following is correct? Okay, so availing the financial services or financial products as per the IFSC Act of 2019 within the IFSC, so this is correct. You can avail the financial services and you can get the financial products also. All current or capital account transactions in any other foreign jurisdiction, so that is also correct, that you can through the FCA, through the foreign currency account that you are holding in the IFSC, you can send or you can do the current or capital account transactions in any other foreign jurisdiction. Making investment in IFSCs, you can make the investment in IFSC in securities except those issued by entities or companies resident in India. If the companies or entities, they are resident in India, like let's say ONGC, GAIL. So if you want to buy the securities of those companies, you can buy in India. You do not have to have the foreign currency account, or you do not have to do the foreign investment for that purpose. So making investment in IFSC in securities, so that is allowed, that you can make the investment in IFSC in securities except excluding those issued by entities in India. So this is also correct, that there is except criteria is providing. Payment of fees for educational and for the hospital services, no. Only the educational services are allowed. The hospital services or such, for that the transfer of the money under the LRS is not allowed to the IFSC. Okay, so payment of fees for the education to the foreign universities or foreign institutions in IFSC, so this is not completely correct, as the hospitals are not allowed. So 1, 2 and 3 are correct. So here the answer is actually D. Got it? I hope this is clear, that remember that at present remittances under LRS to IFSCs can be made only for making investment in IFSC in securities excluding those issued by the Indian entities or Indian companies, payment of fees for education to foreign universities or foreign institutions in IFSCs for pursuing courses or such. Now it has been said that further there is the allowance that has been provided. All permissible purposes under LRS has been set, that is availing financial services or financial products as per the IFSC Act, as well as all current or capital account transactions in any other foreign jurisdiction through an FCA held in IFSCs. So I hope this is clear, that now you can make the transactions for all current and capital account as well as for availing the financial services or financial products. Okay, so this is the idea. Now coming to the next question, that is LRS of Reserve Bank of India allows resident individuals to remit a certain amount of money during a financial year to another country for investment and expenditure. Which of the following statement is or are correct for the LRS, is or are incorrect for the LRS, that you have to tell me. So the LRS is unavailable to corporates, partnership firms, HUF, Hindu Undivided Family and Charitable Trust. So this is correct. It is unavailable to corporates, partnership firms, Hindu Undivided Family and such. Okay. The scheme entails authorized dealers such as banks to facilitate foreign exchange between the resident Indians, between the residents, individuals and the beneficiaries abroad. Under the liberalized remittance scheme, all resident individuals, including minors, are allowed to freely send up to $250,000 per financial year for any permissible current or capital account transaction or a combination of both. RBI introduced the LRS in 2004. Okay, not in 2005. And under the liberalized remittance scheme, the foreign currency convertible bonds issued by the Indian companies in the overseas secondary market, you cannot buy such. Okay, this is not allowed under the liberalized remittance scheme. If you want to buy the foreign currency convertible bonds that is issued by the Indian companies, you have to buy it in India only. Okay, so you cannot buy it in the overseas secondary market under the LRS. That is not allowed. Okay, and that is correct, that it is correctly written here. So only the D statement is incorrect. The D is the wrong statement. So that is the answer. You have to find the incorrect statement. So D is the incorrect statement. So now LRS, I hope you all know that what is LRS. Under the liberalized remittance scheme, the resident individuals, the resident people of our country, they can send the money abroad for their current or capital account transactions, or they can convert their rupees into dollars for taking their money for their traveling purposes and such. Okay, so that is allowed in a financial year. The limit is $250,000 that you can freely remit up to $250,000 for any of your purposes of investment. Let's say you want to do the investment in the overseas portfolio investment you have to do, or foreign currency account you have to maintain, extending loans, you want to extend loans to your relatives and such, or let's say you want to travel abroad, you want to going abroad for employment, immigration, maintenance of close relatives or such. For these kind of current and capital account transactions, you can convert your rupees into foreign currency. There are some limitations also, like remittances for purpose of purchase of foreign currency convertible bonds issued by Indian companies in overseas market. You cannot do this under the LRS scheme, or you cannot buy the banned magazines or the lottery or such kind of transactions. You are not allowed to do. Okay, so you can read that what is not allowed. If you want to see a complete, like if you want to know about LRS, if you want to have the detailed session of LRS, that is already available in the YouTube. You can see in detail that what is the liberalized remittance scheme. Okay, so this is the brief idea that what is not allowed under the LRS is mentioned here, that you cannot send money for the money laundering or such. That is, you cannot send the money for the financial to the countries that is identified by the Financial Action Task Force as non now am I audible? Am I audible now? Am I audible now? Okay, and the voice is clear, like are you able to hear me properly? Nice. Okay, let's continue then. Let's continue. So here, the Reserve Bank of India has been publishing a composite Reserve Bank of India Digital Payment Index since January 1, 2021 with March 2018 as base to capture the existing extent of the digitization that has happened, the deepening and the penetration of the digital payments that has happened, and the value has increased from September 2023 to March 2024, and the value has increased from 418.77 to 445.50. So this is the answer here. Okay, so C is the answer here. Now coming to the there is the increase that has happened from March 2023. If we see that from March 2023 there is the increase of 12.6% in the digital payments. There is the rise of 12.6% in the digital payments from the March 2023 to March 2024. So that is also the idea that was quite in news. Now coming to the next question, that is recently Reserve Bank of India Digital Payment Index for March 2024 stands at 445.50 as against 418. Now you have to tell me that which of the following statement is incorrect. That is what you have to tell. So first of all, RBI had announced the construction of composite Reserve Bank of India Digital Payment Index with March 2018 as base to capture the extent of digitization of payments across the country. Okay. So that is correct, that yes, March 2018 is the base year, as well as the digital payment index has been constructed to gauge, to see the level of or to capture the extent of the digitalization that has happened in the country. The Reserve Bank of India has been publishing a composite Reserve Bank of India Digital Payment Index since January 1, 2021. So that is also correct, that the Reserve Bank of India has been publishing a composite RBI Digital Payment Index since January 1, 2021. Now next is the RBI DPI comprises of 5 broad parameters: payment performance, the payment infrastructure, supply side, demand side payment infrastructure, then there is the consumer centricity, there is the payment performance that is there. Okay, so the payment performance has the highest of the weightage, So payment performance has the weightage of 45%, not 35%. So this statement is incorrect. 1 and 2 is correct, but here you have to tell the incorrect statement. So 3 only will be the answer. So E is the answer here. Yes, very good. So there are the 5 broad parameters according to which the RBI DPI is constructed. So the Reserve Bank of India Digital Payment Index has been constructed with March 2018 as the base period, and the base value is set at 100. Okay, so from 100 you can understand we have moved to 445.50. RBI DPI is published on RBI's website on a semi-annual basis from March 2021 onwards with a lag of 4 months. Okay. Next is this is the basic idea about the digital payment index that you can read. So payment enablers, payment infrastructure, demand side, supply side, consumer centricity, and payment performance. These are the 5 broad parameters for the digital payment index. Okay. These are the 5 broad parameters for the digital payment index. Now coming to the next question, that recently financial inclusion index for the year ending March 2024 has since been released. What is the value of the financial inclusion index for March 2024? So financial inclusion index is the yearly, it is a yearly release that happens. Okay, so the Reserve Bank of India releases the financial inclusion index on the yearly basis. So what is the value here? So the value of financial inclusion index for March 2024 stands at 64.2 with the growth witnessed across all sub indices, but the highest growth has been seen in the usage category. Okay, so the value is 64.2, and the improvement in the financial inclusion index is mainly contributed by the usage dimension. There are actually 3 dimensions or 3 broad parameters under the financial inclusion index. What are the 3 broad parameters? It is the usage, access, and quality. The highest weightage is of the usage, then access, and then quality. Okay, so remember this. Yes. So the composite. Now you have to tell me that which of the following statement is incorrect in regarding to the financial inclusion index. So composite financial inclusion index was first published in August 2021 for the financial year ending March 2021. So that is correct. The financial inclusion index comprises of 3 broad parameters: usage, access, and the quality. That is correct. The financial inclusion index has been constructed with 2020 as base year. So is it correct? No, there is no base year. For the financial inclusion index. Actually, how do we gauge the value of the financial inclusion index, the zero represents complete financial exclusion, while the 100 represents complete financial inclusion. So there is no requirement of base year, as we have the parameters against which, or we have some benchmark against which we can compare the financial inclusion index value. Okay. So the index is responsive to the three broad parameters comprising in all 97 indicators, and the value of the financial inclusion index is compared against the value of 0 and 100. So right now we are at the value of 64.2, that is closer to 100 rather than 0. That means we are closer to financial inclusion in our country. There is no base year of the financial inclusion index. Okay. So this is all regarding the financial inclusion index that you can read. So I will provide you the details in the PPT so that you have the clarity about the financial inclusion index. Okay. So the financial inclusion index is constructed without any base year, and it is published every year in the month of July. Okay. Next is now, this is a notification that the RBI has released. Just the basic idea you require is that on a review and in consultation with the government of India, see, usually what happens that there are some government securities that are identified that is allowed under the FAR, under the fully accessible route. So some government securities are allowed under the fully accessible route, Now what has been said by the Reserve Bank of India and in the consultation with Government of India, that it has been decided to exclude all the new securities, all the new government securities of 14-year and 13-year tenors from the fully accessible route. Consequently, future issuances that are going to happen for the government securities with the 14-year tenor and the 30-year tenor, they will not be provided under the fully accessible route, shall not be available for investment under the FAR route. But for the other securities, or the like the securities that have already been issued, okay, so existing securities that have already been issued, they will be permitted, but the new securities of the 14-year and the 30-year tenor, they will not be provided to the foreigners in the fully accessible route. Okay, so this is the basic idea. Yes, 14-year and 30-year tenor securities, the new securities have been excluded from the fully accessible route. Now coming to the new question, that the UCBs were required inter alia to have at least 50% of their aggregate loans and advances comprising of small value loans, that is loans of value not more than 25 lakh or 0.2% of the tier 1 capital, whichever is higher, subject to a maximum of dash per borrower. Okay, so here it has been said that the UCB should have at least 50% of their aggregate loans and advances comprising of small value loans. So at least 50% of the loans that is provided by the urban cooperative banks should be small value loans, that is the 25 lakh up to the 25 lakh or up to the 0.2% of the tier 1 capital, whichever is higher, but to a maximum of 1 per borrower. That is the idea of the small value loans. Yes, it is the 1 crore. The maximum limit is 1 crore of the small value loan. So this is the basic idea that we have discussed, and the timeline has been provided that by 31st 2025 at least 40% of the 40% of the total loans should be going, 40% of the total loans should be going to the small value, as the small value loans, and by March 31st 2026 at least 50% of the total loans and advances should be going in the form of small value loans, that is up to 25 lakh or 0.2% of the tier 1 capital, whichever is higher, subject to a maximum of 1 crore per borrower. So this is the idea. Now coming to the next question, I hope you will be easily able to answer this question also. Yes, marathon sessions are going to happen. Marathon sessions are going to start after 25th. There will be marathon session, marathon session is going to start from 25th onwards. So there will be reports marathon session, there will be schemes marathon session, GA marathon session will be there. Then RBI news marathon session is going to be also there. That will most probably be conducted on 4th. Okay. So here the answer is the framework for domestic money transfer was introduced in 2011, and there is a review that has recently been done by the Reserve Bank of India in regards to the framework for the domestic money transfer. So payment of amounts transferred from a bank account has a ceiling on the value of such transfers of rupees 5,000 per transaction, subject to the cap of rupees 25,000 per month. So this is wrong actually, because here if we are talking about cash payout, so the cash payout limit on the per value transaction or per transaction is 10,000 with the overall limit of 25,000 on the monthly basis. A walk-in customer that is going to do a cash paying. So a walk-in customer at a bank branch can send the funds up to 50,000 through the NEFT. So that is correct. That's absolutely correct. A walk-in customer that is going to do the cash paying. The walk-in customer at a bank branch can remit funds to a bank account of a beneficiary through the business correspondence or through the ATMs up to a maximum amount of 5,000 here per transaction with a monthly cap of rupees 25,000. So this is the limits that is written here. So first statement and the third statement is wrong. Only the second one is correct, and you have to find the correct statement. So only 2 is the answer here. E is the answer here. Okay. So this is the whole idea, that these were the limits that have been defined. 10,000 per transaction, that is 25,000 per month for the cash payout. For the cash payout, that is you are giving the money through your bank account, and the payout or the money will be taken out in the form of cash. The cash paying means that you are depositing, like you are giving the money in the cash, and that money is going in the bank account of a customer or in the bank account of a person. So that is walk-in customer can do a transaction of the NEFT, or they can send the money through NEFT, that is up to 50,000. And if they are doing it through the business correspondence or ATMs, that is through them, it will be maximum amount of rupees 5,000 per transaction, and monthly cap is 25,000. Okay. Coming to the next question. So this is the guidelines, that there is the update, the review has happened, and there is the cash payout and the cash paying guidelines have been provided, that you have to get the information regarding the customer that is giving the money or that is taking the money. Is there some problem that is happening in the session? Okay. So these are the guidelines, that the remitting bank shall obtain and keep a record of the name and address of the beneficiary. So the records have to be kept. Okay. In the cash paying service, the record has to be kept. And there are the guidelines that you can read. Now under the domestic money transfer, the card to card transfers are excluded from the purview of the DMT framework. So the guidelines on the card to card transfer are excluded from the purview of the DMT framework. So that is the idea. So the card to card transactions will not be covered under the DMT framework. Coming to the next question, try to answer this question. Primary urban cooperative banks were advised that the aggregate of their all the loans against the security of shares and debentures. So the urban cooperative banks are giving the loans against the security of loans and debentures. So there is a limit of 20% of their owned funds. So the limit was 20% of their own funds. Now the limit has been made 20% of their tier 1 capital. So before the limit was linked with their owned funds, now their limit has been linked with the tier 1 capital. So here the answer is 20%. So this is it. This was the news article, that before the limit was linked, the 20% of the limit was linked with the owned fund. Now the 20% of the limit has been linked with the tier 1 capital. So this is the whole idea. Okay. Coming to the next notification of the Reserve Bank of India. So under this notification, the Reserve Bank of India said that the guidelines on treatment of dividend equalization fund. So some of the primary urban cooperative banks, they were creating dividend equalization fund. So dividend equalization fund, through like what was happening in this, that whenever the urban cooperative banks were earning the profits, so they were keeping a part of the profits in the dividend equalization fund. So it was observed that some of the urban cooperative banks have created the dividend equalization fund through appropriation of profits. So as you know that profits are divided into three parts. So from the profits, the corporate tax has to be paid. The corporate profit tax has to be paid. From the profits, the undistributed reserves are being kept by the companies, by the banks. Undistributed reserves are being kept, and from the profits there is also the dividends that has to be paid to the shareholders. So dividends are paid to the shareholders. So from the profits, these three things have to be distributed. The profits are distributed, and the profits are paid for the corporate profit tax, undistributed profits, as well as dividends. Okay. So what was happening that through the appropriation of profits, a part of the profits was sent to the dividend equalization fund, so that in the future, if the UCB is making losses, the dividends can be provided to the shareholders, or in the future, if there is the less profits that is being made by the urban cooperative banks, so dividends can be provided, like good dividends can be provided to the shareholders, so that the shareholders are not able to know that now the company or the bank is not working too well. Okay. So the dividend equalization fund, through appropriation of profits with an intent to utilize these balances to pay dividend in the future years, that we will pay the dividend in the future years when the profits are not sufficient, or when the bank is making the losses. Then we will pay this dividend, then we will pay this part of the profit, so that the shareholders are not very angry, or like they are satisfied. Okay. Or when there is a net loss, then we will pay this part of the profit. However, as per the existing guidelines, the RBI has clear-cut said that in the current year, like from the current profits, you have to pay the dividend in the current year also, so that the shareholders are able to gauge the level of the performance of the company also, the bank also. So if you are earning the profits in the current year, share the dividends in the current year itself. Okay. So that is the idea, that existing guidelines on the declaration of dividends by UCBs prohibit the dividend payments from the previously accumulated profits or reserves, and mandate that if you are earning the dividend in this financial year or in this period, dividend can only be paid by the banks from the current profits, from the net profit of the current year, after making all the regulatory, statutory and other provisions, and after adjustment for accumulated losses in full. So after paying for your losses, after paying for your after keeping provisions, after that whatever is left in the current year, that has to be divided appropriately. So now it is also observed that UCBs have been considering the balances in the dividend equalization fund as a part of their tier 2 capital. So RBI has said that this is not allowed. Why you are doing so? So in order to provide a better treatment of these balances for the regulatory capital purposes, it has been decided as a one-time measure that, okay, for a one-time measure, the UCBs are allowed that first of all, they have to disburse this dividend equalization fund. They have to finish this dividend equalization fund, and whatever money is available in the dividend equalization fund, it has been permitted to UCBs that they can transfer this dividend equalization fund balances in the DEF to the general reserves or free reserves. So transfer these dividend equalization funds that are available, the balances that are available in the DEF to the free reserves. The credit balances in general reserves or free reserves shall qualify as tier 1 capital as per the master direction. So this is what the Reserve Bank of India has said. Got it? Is this clear? So this is the dividend equalization fund. So if a dividend equalization fund, a question is coming that dividend equalization fund is related to which of the following banks, or the concern has been raised in regards to which of the following banks: scheduled commercial banks, regional rural banks, urban cooperative banks, or the small finance banks, payment banks. So it is the what? It is the urban cooperative banks. Okay. Next is Reserve Bank has permitted banks to use ratings from Brickwork Ratings, a credit rating agency, for calculating the risk weights. Okay. So if the banks are giving loans, the loans are the asset of the bank. The loans are the asset of the bank, because on these loans the banks are earning the returns. The banks are earning the returns or the interest rate. So the loans are asset, but there is some risk attached with the loans. So the loans are the assets, but with these assets there is some risk attached. So there are some risk weights of the asset. Now, how do you identify that how much is the risk weight for company XYZ or company ABC? Let's say there is a company XYZ, there is a company ABC. which company has higher risk. How do you know? So you have to see the credit rating of the company. If the credit rating is very high for the company, that means the company is a good company that has returned all its previous loans. So that company should have lesser risk weight. While a company that has lower credit rating, this is a company that is a doubtful company. So it should have like higher risk weight. So the risk weight that will be allocated on the assets, that depend upon what? That depend upon the credit rating agency. So before, in the 2022, the SEBI, Securities and Exchange Board of India, has like banned brickwork, and so the Reserve Bank of India has said that you cannot, the banks cannot take the ratings from the brickwork rating agency. But now the RBI has said that for the loans, the banks can use, the Reserve Bank of India has said that the banks can use the brickwork ratings for new rating mandates for new loans, for bank loans not exceeding rupees 250 crores. So this has been said. Got it? Yes. So in 2022, the SEBI, that is Securities and Exchange Board of India, has said that the brickwork, the brickwork should not be working as a credit rating agency. But the Reserve Bank of India also said that the banks in the country should not be taking the credit ratings from the credit rating agency, that is the brickwork. But now the Reserve Bank of India in 2024, the Reserve Bank of India has said that it is allowed to take on a review. The banks are hereby permitted to use the ratings of the brickwork rating agency, the credit rating agency, for the risk weighting their claims for the capital adequacy ratio, because the banks have to maintain the capital against the risk weighted asset. So the asset must have some risk weight. Okay, so against that the capital will be maintained. So for the risk weighting of your assets for the capital adequacy purpose, you can take the ratings from the credit rating agency, that is brickwork. Okay, now there are some limitation ceilings that are imposed, that in case of the fresh rating mandates for a fresh loan, for a new loan, rating may be obtained from the CRA, from the brickwork, only when the bank loans are not exceeding rupees 250 crores. In respect to existing ratings, the CRA may undertake rating surveillance irrespective of the rated amount if the residual tenure of the loan. That means if the loan is an ongoing loan and the loan also already have got, or this asset has already got some rating, so if the surveillance has to happen of the rating, if another rating has to get, so then the brickwork rating can be used. Okay, so for the surveillance of the rating, for gauging the rating again, for getting the rating again, then the brickwork rating can be used if the rating has already been taken from some other institution. Okay, now in this case, if the rating is taken for an ongoing loan, in this case there is no limitation as such. So for a fresh loan, if you want to take a rating, if a bank want to take a rating for a fresh loan, the loan must be under 250 crores. But for a already existing loan, that is within its tenure period, for the already existing loan, if you want to do the rating surveillance, then you can use the brickwork rating that is provided by brickwork. Okay, so any confusion in this? Clear? Coming to the next notification of RBI. So RBI has released the notification that Dr. John C. Williams delivered 4th Suresh Tendulkar Memorial Lecture. So there are, you can understand that there were 4 lectures that have happened in 2013, 2018, 2020, 2024. You do not need to remember the dates as such, but what is the Suresh Tendulkar Memorial Lecture? So this has been conducted since 2013 in his own honor and in recognition of his contribution to the economic profession and his association with the Reserve Bank of India. Okay, so Reserve Bank of India hosted the 4th Suresh Tendulkar Memorial Lecture in July, and Dr. John C. Williams, President and Chief Executive Officer of Federal Reserve of the New York, came for the lecture, and the lecture was titled Managing the Known Unknowns. Okay, so this is the current aspect that you can remember, that this was the 4th memorial lecture that happened, that was taken by Dr. John C. Williams, and the lecture title was Managing the Known Unknowns, and the first one happened in 2013 in the memory of Suresh Tendulkar. That is it. Now coming to the next question, try to answer this question. Now, the existing LCR framework, liquidity coverage framework for banks in India has been reviewed in light of the recent developments in order to further enhance the liquidity resilience of banks. The banks have assigned an additional 5% runoff factor for the retail deposits. So what has happened that there is the liquidity coverage ratio. Okay, there is the liquidity coverage framework that is there. Liquidity coverage ratio or the liquidity coverage framework is present. You all know about SLR. SLR is what? It is the statutory liquidity ratio. That is the percentage of the net demand and time liabilities, the net demand and time deposits of the bank. So out of the deposits of the banks have to maintain a percentage in the form of cash, gold, or liquid securities, that is the government securities with themselves. Okay, so Reserve Bank of India has set a percentage of SLR that is currently 18%. I hope this is correct. So 18% of NDTL the banks have to keep in the form of cash, gold, and government securities on the regular basis. Okay, so now the LCR framework is also there. That is in a way a global standard. So under the liquidity coverage ratio framework, there is the requirement to maintain a stock of high quality liquid assets. High quality liquid assets is nothing else. It is the government securities, cash and such. So that is the liquid assets have to be maintained. Okay, the high quality liquid assets have to be maintained to cover the expected net cash outflow in the next 30 calendar days. So the liquidity coverage ratio is saying that there is the requirement of maintaining the assets so that whatever the outflow is going to happen, the net outflow that is going to happen in the coming 30 days, the banks have enough assets to cover that outflow. So that is the liquidity coverage ratio, that you have enough assets with yourself to cover the outflow in the coming 30 days. Okay. So however, the recent episodes in some jurisdictions have demonstrated the increased ability of the depositors to quickly withdraw their money. That is, the UPI is there. Like let's say you want to transfer 1 lakh rupees. How many seconds do you require to transfer 1 lakh rupees? 10 seconds, 1 minute most. That is it. So how easily the transfers can happen now? Like before 2016, if you wanted to transfer, it used to take days, or you had to go to the bank, and usually the people are very lazy to go to the bank and to stand in the lines. Okay, they have to take a holiday from their offices also. So before, the transaction of the money or the transfer of the money used to take time. But now the things have become very quick, and there is more capacity. There is more capacity to take out the money from the banks. So that means now the net outflow that will happen from the banks is faster. It is very, very faster. Okay. So it has been said that now there is the requirement of to review the LCR framework. So the liquidity coverage ratio refers to the proportion of high liquid assets that the financial institutions must hold to ensure that they are able to meet the outflow of the money, that they are able to meet the short-term obligation and ride out any disruption if it comes. So in view of the fact that liquid assets under the SLR are already being maintained, we are already maintaining the government securities, the liquid assets under the statutory liquidity ratio, so that we can handle the outflow from the banks. So in view of the fact that liquid assets under SLR and the HQLA, that is the high quality liquid assets under the LCR, they are largely the same, because the high quality liquid assets is nothing else. It is mostly the government securities, cash and such. We have been allowing banks to use a progressively increasing proportion of SLR securities. So SLR securities are what? It is the government securities. So it was allowed that whatever government securities you are keeping under the SLR, they will be counted under the LCR also. They will be counted under the LCR. So the government securities that are being kept under the SLR requirement, that is counted under the HQLA also, that is counted under the LCR also. Now, what is the review that has happened? So there is the review, there is the complete review that has happened of the LCR framework. So Reserve Bank of India in July has done the review of the LCR framework. So what the Reserve Bank of India is saying, that the banking has undergone rapid transformation in the recent years. There is more risk now because mobile banking is there, internet banking is there, NEFT, RTGS, IMPS, UPI, many systems are there through which easily the money can be taken out. So we need to make the LCR framework more strong. Okay. So the existing LCR framework for banks in India has been reviewed in light of recent developments, and there is the draft guidelines that have been released. As per the draft guidelines, banks shall assign an additional 5% runoff factor for retail deposits. Runoff factor means outflow. additional 5% of runoff factor for the retail deposits have to be imposed. That additional 5% of the runoff factor means additional 5% outflows can happen more, okay, which are enabled with internet and mobile banking. So the runoff factor to the retail deposits which are connected with the internet banking, like your fixed deposit. Is it connected with UPI? Remember that when you do a fixed deposit, there is a separate deposit account that is created. So only your savings account is connected with your internet, like mobile banking, or your savings account is connected with UPI. Your deposit accounts, your FD account, it is not connected with UPI. So the retail additional 5% of runoff factor should be given to the retail deposits which are enabled, which are connected with the internet and mobile banking facilities such as UPI, such as mobile banking, internet banking and such. Stable retail deposits, that is stable retail deposits. Stable retail deposits means that are in the savings account usually. Stable retail deposits enabled with IMB, internet and mobile banking shall have 10% of runoff factor. That is, after the additional 5%, the stable retail deposits will have 10% of the runoff factor. And less stable deposits. Less stable deposits means that is in the current account. That is for the merchant purpose, or that is for the transaction purpose usually. In the current account, there is very fast transactions that happen. So the less stable deposits enabled with IMB shall have the 15% runoff factor after the additional 5% has been included. Got it? Got it? This much is clear. Unsecured wholesale funding provided by non-financial small business customers. Let's say the non-financial small business customers. Let's say a small kirana store, a small restaurant, a small shop. They are giving the wholesale funding. They are giving, like, many transactions are coming to them, like 100 customers are going to the restaurant. So 100 customers are paying to the restaurant. So there is a wholesale funding that is going to the bank through these small businesses. Now wholesale funding, the amount that is going to the bank through this non-financial small businesses customers shall be treated in accordance with the treatment of retail deposits only, because the merchants can take out their money whenever they want. So this should be treated as the retail deposits only. Next is level 1 HQLA. Level 1 high quality liquid assets are usually the government securities or cash and such. Okay, in the form of government securities shall be valued at the amount not greater than their current market value, adjusted for applicable haircut in line with the margin requirements under the liquidity adjustment facility. So haircuts, let's say government securities, the market value of the government securities we are taking, but we have said that under the liquidity adjustment facility we will take 5% of haircut. 100 is the value, so we will take the value at 95 rupees because we have taken 5% as the haircut. 5% is the margin requirement or something. Okay, so that is the idea. Next is, in case a deposit excluded from LCR computation, for instance, a non-callable fixed deposit. Non-callable fixed deposit means it is a fixed deposit that cannot be taken out before the maturity until and unless there is the death that has happened or there is some extreme scenario that has happened. Non-callable fixed deposit means that is a fixed deposit that cannot, in whatever circumstances, it cannot be withdrawn before the maturity. So those are non-callable fixed deposits. So non-callable fixed deposits cannot go out. This is the permanent deposit of the bank till the maturity. But it has been clarified by the Reserve Bank of India that even in case of non-callable fixed deposit, let's say that there is a loan that has been taken, that someone has taken a loan or someone has done the overdraft against the security of the non-callable fixed deposit. You can use your fixed deposit as the collateral. Okay, so let's say that the loan is not being paid back by, let's say I have the non-callable fixed deposit of 10 lakh rupees, and I have taken a loan of 7 lakh against this non-callable fixed deposit. Now I am not able to return this loan and I am saying that I am bankrupt or I cannot return the loan. So now from whichever entity I have taken the loan, they can use this collateral. They can use this collateral. Even if it is a non-callable fixed deposit, it is the collateral and they are entitled to the collateral. They are entitled to this collateral. So they can withdraw the money. So it has been said that in case a deposit is non-callable fixed deposit, this is contractually pledged as collateral to a bank to secure a credit facility or loan. Such deposits shall be treated as callable fixed deposit because whenever default is happening, this fixed deposit will become callable fixed deposit. Okay, that whenever default is happening, so it can be called by the bank, it can be taken out by the entity. Okay, got it? Clear? This is the whole LCR framework. This is the whole idea regarding the update that has happened, and this is it. This was the last notification that we had to cover, and this is the whole idea. So I have not covered this in a separate session. That's why I have brought it in detail here. All the other like PCA framework, the digital payment index, financial inclusion index. So we went faster in that because we have already covered that in the separate sessions. If you want to see the sessions, you can see the sessions. But this LCR framework, I have not taken a separate session on that. So I am bringing this in detail here. I hope this is clear. The percentages you have to remember that the banks shall assign an additional 5% runoff factor for the retail deposits which are enabled with internet and mobile banking. That means a stable retail deposits will have the runoff factor of 10% and the unstable or less stable deposits will have the runoff factor of 15%, as well as the non-callable fixed deposits, if they are like a collateral, so they will become the callable fixed deposit. Okay, so this is the basic idea. Most welcome. Any confusion, anyone now? Ma'am, any technique to learn so much data? It's becoming confusing. So see, different faculties, like in my case, there is, what you can do is write down the points. If like only 10 or 15 notifications come in 1 month, those are the important ones, right? Like it's not like that hundreds are coming. It's not GA, it's not finance current affairs, it's not schemes. That hundreds of the schemes you have to remember and such. Every month maximum you have to do 15 or 20, maximum 15 or 20 notifications. In that 15 and 20 notifications also, the data is limited. So try to write down the data somewhere and try to understand, try to relate the things. Okay. So that is the idea. In my case, I can tell you this, that you have to write down the data and you have to understand the things. If you understand the HCR framework, if you understand the SLR, then you can remember the data easily. Okay. In the other GA and such, in the GA, in the schemes, reports, you have to ask the faculty who is taking such sessions. Okay. Sandeep, it will be covered. Like this one, it is the draft framework now. So it is going to be covered in August. Okay. Most welcome. So this is it from my side. Do tell me, like we have done 15 questions. So do tell me that how many you scored out of 15. How much you have scored out of 15. Okay. And tomorrow we are going to have the revision session for August. Okay. Tomorrow. I'm not feeling well. So we will have to see that tomorrow's session is possible or not. But I can say that I will be taking the session, but in the like 0.1% of chance can happen that I might not be able to because I'm not feeling very well. So, but tomorrow at 7 p.m. tomorrow, you will have the August session, August RBI notifications and press releases session. Okay. If you are preparing for NABARD, I think you should focus on ARD, like agriculture and rural development. You have to focus on the ARD static, you have to focus on the schemes, reports and such. So rather than focusing on something that is going to come for 1 or 2 marks or maximum 3-4 marks, rather than that, put your efforts where it is going to provide you benefits. Okay, so do the cost benefit analysis. Most welcome, most welcome. RBI booster, I will talk to the team. I think they have released the boosters, or they are going to release soon. Yes, they were discussing, so they are going to release it soon. Okay. Notifications last 4-5 months should be done. Like it is compulsory for to do last 4 months of RBI notifications. If you are not able to do last 4 months, at least last 3 months. Okay. Last 3 months are most important. Last 3-4 months are most important. After that, you can go to the 5th and 6th month also. If you have the time, if you do not, at least do 4-5 months. Very well. Thank you so much. Do comment down below also in the comment section, and do tell me that out of 15 how much marks you have got, and do tell me in the comment section that if you like the session. Okay. So tomorrow I'm going to come with the August session, August RBI notification and press release session. Thank you so much. Thank you so much. Means a lot. Do comment down below, and this is it from my side. I hope you enjoyed the session. If you enjoyed the session, do tell me in the comment section. If you liked it, it will be a great booster for me also. And tomorrow we are going to discuss the August RBI notifications and press release. Okay. Durga, that is being taken by Devanshu sir and Gurkirat sir. Yes. What? Thank you, Abhi. So at 7 p.m. tomorrow we are going to meet for the August session. Okay. Any other confusion anyone has? I hope you liked today's session. Okay, then I can see that there is no further query. So thank you very much, everyone. Thank you for joining the session. Let's meet tomorrow. JA plus ESI is being taken by, I think Gurkira sir is taking ESI plus finance and Devanshu sir is taking the JA session. Na? In the marathon session, when I bring the marathon, then in that session, I'm going to bring the finance current affairs also. But in this regular sessions, I'm going to take the RBI notifications and RBI press releases. Gurkira sir is taking the ESI plus finance wala section. Okay. Okay, then thank you very much for joining the session. Thank you all.